Happy Thursday out there, Team 42. It's your skipper here, Darius to present our macro minute for Thursday, February 20th, 2025. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is, how is the debt limit impacting asset markets? Our answers are the U.S. Treasury's statutory debt limit is currently acting as a significant tailwind for asset markets. The Treasury Department's extraordinary measures have likely been exhausted, and it has likely begun financing federal expenditures and debt service with its cash balance. At the current pace of decline, the TGA balance will likely hit $0 sometime in early July. All told, the following five things are either true or likely to become true in short order, according to our analysis. U.S. liquidity is about to inflect into a meaningful uptrend thanks to a likely persistent decline in the TGA as Congress debates the merits and contents of a single reconciliation bill authored by the House versus two separate reconciliation bills authored by the Senate to legislate President Trump's economic agenda. Number two, global liquidity is on the precipice of a modest uptrend that may be further accelerated by U.S. dollar weakness if the Trump administration pursues a strategy of reciprocal tariffs. Number three, the Fed is likely to end the Treasury portion of balance sheet runoff in the first half of 2025. Number four, reported inflation data are likely to be better behaved in the coming months, at least until the late second quarter. And number five, retail traders are meaningfully underweight risk assets, as evidenced by the current 16th percentile reading in the AII Bulls Bear spread. We reiterate our view that the current risk on market regime condition is likely to persist throughout the first half of 2025. The second half of 2025 is when we see the risk from our sticky inflation and triple S's themes contributing to a potential global debt refinancing air pocket. And we know what those do to asset markets. They cause trending risk off market regimes, typically crashes. All right, transitioning to our 42 macro dashboard. As always, a wrap up the question from our community. This one's titled Liquidity Dry Up. It says, is there a dry up in liquidity that coincides with global refinancing? How fast will the volatility transpire into risk assets? Now, quickly before the crash, does Dr. Mo and other risk management signals pick up on it? So if there is a liquidity drop that coincides with global refinancing, that is what a global refinancing air pocket is. It's essentially there's not enough global liquidity being created fast enough to offset the rise in global refinancing demand. And historically, that has typically perpetuated, trending risk off market regimes. A lot of times they result in crashes in broader risk assets, S&P, Bitcoin, et cetera. And so that is a meaningful risk over the second half of the year, because ultimately, you're going to have a lot of competing forces for that liquidity, especially if we see a significant drawdown of the Treasury general account balance. They're going to have to refill that on the other side. Obviously, we're not issuing net new debt on a net basis here in the United States while the debt limit is currently being breached. So ultimately, what that means is on the other side of that, there's going to be a lot more net new debt. And so, you're talking about a United States government that already has about $12.5 trillion, or really somewhere close to $12 trillion of gross Treasury financing that needs to take place over the next 12 months. That's part of that global refinancing demand, but there's also a lot of private sector demand stemming from the companies turning out their debt back in 2020. So that's an issue. That's a potential risk for asset markets in the second half of 2025. That risk will be mitigated to the extent we see the Fed and other central banks really step up on the liquidity provision side. It's hard to envision a scenario from today based on everything we think we know about the inflation process and resiliency of the U.S. economy where that actually takes place. So there's a lot of market risk for the second half of 2025, but that's not something we need to be overly concerned about here on February 20th. And then the second half of the question is how quickly before the crash does Dr. Mo and other risk management signals pick up on it? So I'll really quickly, our signals are extremely good at getting clients out near the top. So there's sort of a three, if you think about how our risk management signals are orchestrated or organized, there's our market regime nowcasting process. So that's probably the best thing we do is risk nowcast the market regime, sending clear and actionable signals. Hey, we're in a risk on regime now. We're in a risk off regime now. Usually there's about one, maybe two of those signal changes per year. So investors need to be aware of that. So once we send those signal changes out, they get filtered through either our KISS portfolio construction process or our discretionary risk management overlay, aka Dr. Mo. KISS is for retail investors, very simple, easy to execute. Stocks, gold, Bitcoin. Dr. Mo is it's more sophisticated and not complicated. It's more sophisticated for institutional investors and sophisticated retail traders because it sends out those same types of signals, but across 70 different factors that investors are trading long and short in their portfolios. And so on the KISS side of things, anchoring on the COVID crash, because that was the fastest crash we'd ever seen in U.S. history outside of the 1987 crash. That was the fastest 30. The COVID crash in the S&P 500 was the fastest 30% decline in U.S. stock market history. So anchoring on that as a proxy for, okay, what happens in a very quick, expeditious crash-like scenario? How well do our signals perform on an out-of-sample basis? And when you look at the KISS back test, the max drawdown during COVID for the entire KISS strategy was minus 11%. That compares to around 25% if you were running 60, 30, 10 stocks, gold, Bitcoin without our risk management signals. And that compares to around 22% for 60, 40. So obviously 11% is, less than half of what you would have experienced, if you weren't paying attention to our signals with that kind of exposure. And obviously exactly half of what you would experience if you were just running 60, 40 naked long during that. So obviously very good timing there. On the Dr. Mo side, in fact, I actually have a chart here I can show you with respect to Dr. Mo. So this is the evolution of our Dr. Mo signals on a rolling out of sample basis for the COVID crash. So on February 28th at S&P 2954, Dr. Mo would have taken our Dr. Mo's proper trade recommendation for the SPY ETF would have gone from a long max position to a no position. We don't, Dr. Mo, it would have gone from a long max position to a no position there, and it would have missed the last 24.5% decline in the S&P 500. So that's obviously a phenomenal signal. You're booking gains, just shy of the all-time high in the market before a significant, drawdown of 25%. And then this line here indicates when Dr. Mo would have got you back long. So you would have missed that. You would have sidestepped that whole 24% drawdown and got long 3 days after the low. It bottomed on March 23rd, 2020. And Dr. Mo would have gotten you back long starting on March 27th of 2020. So this is why we do what we do. We say we're the world's leader in macro risk management. I genuinely believe that in my heart of hearts. Maybe not everyone around the world believes that yet, but at some point in the next 5 to 10 years, I think everyone around the world will believe that. We know what we're doing here when we design these risk management systems, these quantitative risk management systems. And we ultimately understand that they add a tremendous amount of value, both in bear markets, but also in bull markets. We've been on the right side of the raging bull market risk that we've been calling for since January of 2023. And so, we're really proud and really happy for our clients who participated in that raging bull market. And, and they're not only participating, they can feel confident sleeping well at night, knowing that those same exact signals that have kept them on the right side of market risk in terms of maximizing upside capture in this bull market are the exact same signals that will help them book gains and sleep comfortably at night if and when the bull market eventually ends and transitions to a bear market. So, I think we know what we're doing. We have thousands of clients around the world who very much agree. And so appreciate everyone for tuning into these. And we'll catch you back on Monday. I'm going to be offline tomorrow. So catch you guys back here on Monday. Clients, I'll see you on Saturday for the Around the Horn. Everyone have a wonderful weekend. Cheers.